Hey guys, hope you're doing well out there. The retail industry has really underperformed year to date. Now, in particular, there's three names in that space that have significantly underperformed, not just the AI trade that's been powering the markets higher, but in fact, even the retail trade as a whole. We're taking a look at three of those names today, and that is Lululemon Athletica, ticker symbol Lulu. We're also taking a look at Ulta Beauty, and then lastly, we'll take a look at Dollar General Corporation, ticker symbol DG, as all three of these names are down nearly 50%, not just over the past 1 year or 5 years. Yeah, that's just year to date. These stocks have seen significant declines in their share price. So we'll take a look at all of their Q2 results, which came out just about a week or two ago. We'll take a look at the valuations, the news as it surrounds some of these names. We'll jump into the financials for all these companies, and then we'll take a look at the technical chart patterns as well, see if there's some opportunities to maybe pick up a bounce higher on these trades, or perhaps it's wise to stay out of them once and for all. I'll have timestamps in the description below to jump around to any of these companies that interest you the most. We'll also end things off by highlighting two ETFs, which I think if you're interested in the retail space may make a lot of sense without having to take the outsized risk of investing in these names individually. If you guys are new to the channel and find this type of content valuable, be sure to hit that like and subscribe button below. It would be much appreciated. Kicking things off with Lululemon Athletica, this stock is down more than 49% year to date. Over the past 1 year, you're down over 30%. Over the 5 years though, still holding up right around 40%, but keep in mind you're underperforming the S&P 500. Certainly not great performance over 5 years. And Lululemon for the longest time was seen as a name in the stock market, really a high quality growth company, high quality compounder with a bright, promising future ahead of itself. So how does a company like this decline nearly 50% over the past, call it 9 months? That is certainly surprising. Now, the last time we took a look at shares of Lululemon, the market cap was closer to $40 billion, now trading near around $30 billion. So you saw another roughly 25% get shaved off its market cap. Now, last week on Thursday, shares of Lululemon reported their Q2 results, and well, needless to say, they weren't great. You had revenues come in higher by right around 7% year over year, up to $2.37 billion, but consider the fact that that did miss estimates on Wall Street by right around $40 million. Now, what you did have a beat on is the bottom line earnings, as GAAP EPS came in at $3.15, beating handily Wall Street's estimates lower that were nearly 23 cents underneath what Lululemon posted. Now, on top of a basically mixed Q2 print of a revenue miss and an earnings beat, the more important number, as you'll see with a lot of these retailers, is the comp store sales, otherwise known as same store sales. Look, any retailer can grow their revenues by just opening new stores. That additional new store count certainly does contribute to revenue growth, but what you really want to see with not just Lululemon or Ulta Beauty or Dollar General, really any retailer, you can take a look at Costco or Walmart, is you want to see comp store sales tick up higher year over year. Now, we saw comp store sales over at Lululemon up just 2%, whereas the Wall Street estimates were for comp store sale growth of nearly 4.5%. So any stores that have been open for over 14 months are growing at just 2%. That tells me that this company isn't really able to grow revenue organically for their existing stores. The only way they can really achieve the 7% revenue growth rate is by opening new stores. Now, while that's great for now, it's certainly not a sustainable thing as the quarters roll on. Now, on top of a mixed Q2 print, this company really didn't have great guidance, as that came in shy of Wall Street estimates, but also Lululemon having to lower their full year revenue guidance, again showing weakness in this business for the quarters to come. Now, in terms of Lululemon's Q3 guidance, they're estimating roughly revenues to come in the range of 2.34 billion all the way up to 2.36 billion. Consider the fact that that is underneath what Wall Street anticipated at the midpoint of 2.41 billion. So coming in right around $500 million shy on their midpoint compared to what Wall Street anticipated for the revenue figure. On top of that, they're also coming in underneath Wall Street expectations on the EPS line, as they're guiding for a midpoint, call it at $2.70. The consensus was for $2.73. Now, Lululemon did come in with a pretty nice beat in their Q2 EPS figure, so maybe you can expect them to come in with a nice beat on their Q3 EPS figure as well, but consider the fact that their own guidance coming in underneath the average estimate on Wall Street, certainly not a good look at the current time. Now, what's even worse is the fact that Lululemon having to lower the full year revenue guidance themselves, again proving to be a challenging environment for this company at the current time. So now they're guiding for full year 2025, which is really calendar year 2024, revenues to come in the range of 10.37 billion up to 10.47 billion. The initial guide given out by Lulu was for 10.7 up to 10.8 billion. So coming in again, $500 million shy from their own guidance. On top of that, coming in underneath the consensus estimate for $10.62 billion. And then on top of all of that, what's even more surprising is that they actually lowered their earnings guidance, now basically at $14. What's surprising though is last quarter they actually raised their fiscal 2025 guidance for the full year up to $14.27 all the way up to $14.47. So consider the fact that this company raised its full year earnings guidance last quarter, and now they're once again bringing that down. So it almost seems like management themselves are unsure what the quarters ahead will look like. And really, anytime you have management being unsure what the quarters ahead will look like, yeah, that just tells you the estimates on Wall Street really can be pretty confusing, and they're not very sure what this company really will post, because you have Q4 estimates for the midpoint on the revenue side come in at $3.5 billion. That seems relatively in line, but when you take a look at the earnings estimates, that is in a wide range. For the fourth quarter, the low end is at $4.88, whereas the high end is at $5.77. So that's a pretty wide range for just 2 quarters out. Not a lot of predictability when it comes to Lululemon at the current time. They have the range, or rather I should say upside, to come in with a nice EPS figure of right around $5.60, but consider the fact that they raised their EPS guidance last quarter, which they're now lowering for the full year. I think this company or this management team really isn't sure what the earnings will ultimately look like, and so I think if management themselves aren't very confident in the predictability of this business, I think as an investor, that certainly doesn't give me the confidence either. Now, on top of that, along with same-store sales pressure and a guidance cut, I think there's 2 main things that are really contributing to that. The first is just simply competition. This is a space, the athleisure space is becoming a crowded market, and you don't just have your high price tag names like an Alo and Vuori. You on top of that also have budget athleisure brands coming out of China that are really ready to make dupes from anything Lulu produces at a basically fractional price tag that of Lululemon's. But I think Alo and Vuori are 2 premium brands in the space that are having some serious competition when it comes to Lululemon. They're taking significant amounts of market share from what I see. Now, the 2 brands do look a lot like Lululemon, and not just in the wardrobe department. They also boast high quality cuts with high price tags to match. They are 2 sported on the streets by tastemakers and celebrities, and they too share versatile appeal that spans a broad range of spectrum. And then in addition, these companies like Alo and Vuori are beginning to create a lot of online buzz, with Google searches for each of these brands peaking last December. And right here we see over the last 4 years, searches for Alo and Vuori have steadily been increasing, and they've really been peaking in that December time period. And what I expect is for this upcoming holiday season, the Google trends for Alo and Vuori to continue to remain strong. So these are 2 premium brands that are really eating in to Lululemon's market share and brand power. And so that tells me this company will begin to lose things like pricing power. They will begin to lose their moat, and their consumers will really have the options that they once didn't have. I think before the pandemic, Lululemon was the clear dominant winner in the space, considering now that after the pandemic, you have a big boom in the athleisure market. You've seen these companies recognize that there's a lot of market share to be taken in the space. There's a lot of pricing power to be taken from Lululemon, and they're coming in and doing just that. So anytime I think you have premium brands come in this space, eat up pricing power from Lululemon, that's not a good thing. On top of that, I think you have duplicates coming out of small retailers from China that, again, always pose a threat to a company like Lululemon, especially in North America, where if you can really get the same type of leggings and athleisure wear for a fraction of the price tag at a point where consumers are really pinched on their wallets, I think it's a pretty clear choice that they can make to switch down to a cheaper alternative. Now, that was the first thing that I think is affecting Lululemon's moat, at least at the current time, is competition really eating away. The other thing is I think Lululemon themselves have dropped the ball on a number of product releases. So they've really misstepped and mishandled a bunch of product releases in the past. Now, in the most recent conference call, the CEO, Calvin McDonald, did address some of that by saying the restructuring within the executive suite to give more emphasis on design, making the global creative director a direct report to the CEO. Now, first of all, I'm surprised this wasn't already a direct report to the CEO, considering Lululemon, if they have poor design or poor creative choices, yeah, that pretty much destroys their brand right there. And that's exactly what we've been seeing has been happening to this company, as their creative director recently did depart, Sun Ko. And so if you believe Lululemon management in saying that they're going to emphasize more on design, more on the creative side, then I think, yeah, if this company can begin to put out some products and sizes and styles and colors that appeal to their core consumer base, that appeal to a newer consumer base, then I think this company does have room to move forward. Now, CEO comments were made saying that moving forward, he feels confident that the new structure and relationship between design and merchandising will lead to ongoing conversations and consistent decision making. He's excited about the newness and innovation, and that will be flowing into the upcoming product assortments. And you had a Bernstein analyst that is pretty bullish on this name, saying that management sounded more realistic and constructive about the issue, which has been a stale assortment with specific lack in new styles and sizing, particularly in their core franchises, and then the things they're doing to address it, and that is by adding more newness in key areas and also fast tracking production on a realistic timeline, saying that there's going to be some improvements in the back half of this year and a full run rate expected in the first half of 2025. And he's saying the innovation pipeline remains robust, and more importantly, the second half guidance does not include any meaningful impact from the new products. So this really tells me is that if the new products that are coming over at Lululemon, expecting to be really in ramp by the first half of 2025, if those new products really hit home with their core consumers, then I think that is your upside with this name. For the next fiscal year, revenue is expected to be roughly around $11.34 billion. If those new products can certainly hit a new tone with consumers that they haven't really been hitting for the last couple of years, if they can outsize their competition like Aloe and Vuori with better styles, with better sizing, with more color options and more variety, then I think a $12 billion higher target certainly is achievable for this company. And if they are able to come in closer to this $12 billion figure for fiscal 2025, that is your upside with Lululemon. I think at that point, the stock certainly is undervalued and will certainly see moves to the upside. But with that being said, that is a big if. I think it's still too early to decide whether those new products will certainly hit home with the consumers, also whether those new products will be able to compete with the likes of Aloe and Vuori and really gain back that market share that those companies have stolen from Lululemon. So I think that's still a wait and see approach for me. I think it's still too risky and too really unpredictable to know whether those new products and whether the production timeline really will be met by management and will hit home with their core consumers. Now, from a financial perspective, we really see those two things playing out almost perfectly. We see the competition taking away their pricing power in terms of margins. We also see them not really expanding or growing their revenues as fast as they once were, not really being the same growth company they have been known for, simply because their new products aren't hitting home with consumers. So net revenue is coming in at $2.37 billion, still higher from a year ago, but keep in mind a lot of that is due to new store openings rather than same store sales growth, which really, again, in the retail world is, in my opinion, the most important number. You can take a look at any retailer, and that is the number that I really pay attention to. So last year we had $2.2 billion in net revenue. Now on top of that, you had some expansion in your cost of goods sold. Again, those expanded, but nearly not as fast as your net revenues. And so you saw some benefit on your gross margins as those ticked up from 58.8 up to 59.6. And then on top of that, you saw some operating leverage as they were able to increase the operating margins from 21.7% up to 22.8%. So they still raised their SG&A expenses year over year, but not nearly as much as total revenues. Similar story on a 6-month basis. You're seeing very minimal margin expansion from 37.2%, from 20.9% up to 21.2%. That's on the operating margin side. So this company, despite the competition, still able to relatively hold margins in check to slightly tick them higher. I think this quarter was in particular better on the margin side than we have seen in the past. But I think these margins are still well below what Lululemon used to once put up, simply because the competition has entered this market and they've had to do further and further promotional activity to just move through their merchandise, move through some of their old products as they make room for new ones. Now, with that, you do have some good things over at this company. They're reducing their shares outstanding. We'll see that when it comes to the buyback on their cash flows. The other really, really good thing about Lululemon is their balance sheet. This company really has a fortress balance sheet with cash and cash equivalents coming in at $1.6 billion. Now, over the last 6 months, that is down from $2.2 billion, but consider the fact year over year, you are still up, as last year your cash was closer to $1.1 billion. Again, inventories year over year declining right around 14%, now down to $1.4 billion. Some of that is probably them moving through some old product, probably discounting that in order to make room for the new products expected to come in the second half of this year and then early next year. We see this with Nike all the time, as controlling inventories for these retailers, especially these apparel makers, is always challenging, because if they look to move through these inventories rather quickly, they'll have to do heavy markdowns, heavy promotions, but at the same time, you can't have those inventories sit in your warehouses for too long, because you always have to have that new product innovation pipeline, and as the existing products continue to sit there, well, they'll simply become outdated. So managing inventory is probably one of the hardest parts about being one of these large-scale apparel makers. Now, apart from that, you have nearly $3.5 billion in current assets. That's balanced out by not a ton in liabilities. You have some lease liabilities of right around $300 million that's paying rent on those Lululemon stores. You have some accounts payable, some other liabilities, but all things considered, not a ton of debt, not a ton of liabilities. So from a balance sheet perspective, that's something to really, really like with Lululemon. Also, something to like is from a cash flow perspective, you are still cash flow positive, still generating a decent amount in free cash flow, as over the last 6 months, operating cash flow is coming in at $570 million. Consider the fact that they still have to open new stores, also remodel existing ones, and so CapEx remaining relatively high, close to $300 million. So you have, call it right around $300 million in free cash flow. That's over the last 6 months for shares of Lululemon. Now, do consider the fact this company, like all apparel makers, generate a vast majority of their revenues and those cash flows in the holiday Q4. So as you get closer to the Q4 print, I think the cash flow figure for this company does tend to look a lot better. But nonetheless, $300 million in free cash flow over the last 2 quarters, still pretty good. Consider the fact that, again, fourth quarter, they'll generate a fair amount in free cash flow. They do buy back nearly $900 million worth of their common stock. Again, this is over the last 6 months. So from $300 million in free cash flow, doing a $900 million buyback, that, simply just means $600 million of that buyback came off of their balance sheet. We see that as that shows up in the decrease in cash and cash equivalents. So this company is doubling down on themselves. They are doing the buyback basically out of pocket as of now. Consider the fact that their balance sheet still looks pretty good. They have a fair amount in cash and equivalents, so they can continue to do a fairly aggressive buyback. But at some point, you'd want to see those cash flows catch up to the buyback that this company is doing, or this company will simply have to pull back on the buybacks that they're able to do. Now, from a technical perspective, shares of Lululemon actually looking even worse than they are fundamentally, as you had a pretty good line in the sand right here at $289, $290 a share. You didn't want to break through that support level. Once you did, you were basically in free fall. You came all the way down to $227 a share. You have since seen a recovery up to $260, but again, this $280, $290 level was a pretty good support for a long time, dating back to June of 2020. Once you broke through that, there's not a whole lot of support with shares of Lululemon underneath. So I think this one can continue to basically slide, in my opinion, because you don't have a ton of support at this point. You will again have resistance on your way higher right here at 290. So I will turn that line red, because that will now choose to be overhead resistance, in my opinion. I think what comes next for Lululemon from a share perspective is this company is in a steep decline. I think you can see periodic reversals as it continues to try to move up. I think you'll see some resistance at $290 a share. If you can come in here and break above that and then backtest down to 290 and show that it is support, I think you can play this one from a trading perspective, where you maybe look to pick it up around 290, set a very tight stop loss around 270, and then maybe hope to play the upside all the way up to $360 a share. That's really how I would play shares of Lululemon. Wouldn't be overly excited to jump in at this point, because again, not a whole lot of support that's underneath these shares at the current time. You probably have some support right here where it bounced off at 235, but I wouldn't be counting on that. So really picking this up from a technical perspective seems to be a gamble at this point. You've basically been making a ton of falling knives. I wouldn't be excited to catch it. I would rather wait for a reversal, wait for a test of this $290 range, and then try to pick it up as it moves higher, in order to basically have a trade to the top end of this range, closer to $360 a share. The good thing at this point is the valuation at this $260 range really supports this stock now, because you're trading right around, I believe, an 18 times forward earnings multiple. And again, if you have some room to the upside in terms of outpacing what Wall Street anticipates for the EPS, then I think the 18, 17 times earnings multiple certainly is fair for this company at this point, because look, they're still a decent retailer with some growth at the current time. And so I think the valuation, along with Lululemon buying back their own shares, will put some sort of a floor on this name. It's just hard to tell when that will come in. And so from a technical perspective, not really looking to gamble in at this point. I would wait for a reversal and then look to maybe pick it up close to $280. And then from a fundamental perspective, I'm not really sure what this company is thinking, because they once guided for EPS to be higher. Now they've revised that EPS to be lower. So they seem a bit confused from a management perspective. I'd have to wait to see what those new products really look like, how they compete against existing competition, both in the premium space, but also in the discount space. And while I like Lululemon's valuation at this point, I don't like the predictability in this business over the next 6 to call it 12 months. I think it's just a wait and see approach that I'm taking with shares of Lululemon. Moving on to another retailer that's really been struggling year to date, and that is Ulta Beauty, ticker symbol Ulta. Year to date, you're down nearly 28% on this name. Over the past 1 year, down roughly 17%. Over the 5 years, you're up still close to 50%. And then over the last 10 years, you've done quite nicely with shares of Ulta up 250%. In fact, this is one of those retailers that for the longest time was seen as a high quality name, similar to a Lululemon, had solid growth supporting its fundamentals. Now you've seen that growth really shrink and dwindle down to basically no growth, and that's really hurting this retailer. Now Q2 revenues, which again Ulta posted I believe on Thursday last week, revenues came in at $2.6 billion. That was good for 4% growth year over year. This one looking even worse than Lululemon, as you had a double miss, a revenue miss of nearly $10 million, and then an EPS miss of close to 15 cents, as GAAP EPS came in at $5.30. Now, similar to Lululemon, you're seeing very slow growth in the comp store sales. In fact, with Ulta, you're seeing comp store sales actually declining 1.2%. So despite this 4% revenue growth, the stores that were already been open for over a year are actually seeing their revenues or their sales decline on a year-over-year basis. So again, showing that this retailer really is struggling. Similar story over at Lulu, as the competition really heating up in this beauty space, and their biggest competitor really is eating into those sales. Now, full year revenue consensus estimates were for $11.5 billion. What Ulta Beauty guided for is actually a lowered full year sales outlook of right around $11 billion up to $11.2 billion. So their prior outlook was in line with what Wall Street anticipated. They've now brought those estimates down really across the board. And so even previously they were guiding for full year comp store sales to increase 2 to 3%. Now that growth is expected to be in the negatives 2% up to basically flat comp store sales. They're not changing how many new stores they're going to open, so they still plan to open nearly 60 new stores, remodel close to 40 existing stores. So the CapEx plans really staying in line, as they're not bringing CapEx down all too much, but what they are again bringing down is expectations for the operating margins to come down to basically 13% from 14%, and then diluted EPS also to come in closer to $23. Previous guide was for closer to $26. So this company really, again, similar to Lululemon, reining in those full year guidance expectations, because they've simply not seen that same store sales growth as fast as they would hope for. And so as you look ahead, this company is expected to grow in the low, call it mid single digits, nearly 4 to 5% for the upcoming quarters. From an earnings perspective, you are expected to see a struggling Q4 with EPS declining nearly 15%, and then once again ramping back up to modest single digit growth on that EPS side. So I think your upside with Ulta is if this company comes in with EPS growth in the next fiscal year surpassing 9%. The valuation on this name certainly doesn't seem to be egregious at right around a 14 to 15 times forward earnings multiple. And so if they can post even just double digit earnings growth close to 10 or 11%, I think that's enough to send shares higher, enough to basically push the valuation higher than basically a 14 times earnings multiple. Now, similar to Lululemon, it's the competition and the promotions that are really weighing on margins and weighing on this company's sales, as investment firm Piper Sandler did downgrade the stock from overweight to neutral, as it sees further erosions in the profit margin due to shrinkage, increased promotions, slower sales, and then of course increased competition. I think competition really for all of these retailers is the calling that's causing them to struggle, at least year to date. And for Ulta Beauty, their biggest competitor is Sephora, as they have a big collaboration with Kohl's, really expanding that store count rapidly over the past. On top of that, I think you have Amazon's new beauty offering also weighing significantly on Ulta's revenue outlook, and they're basically trimming those sales and EPS estimates for the upcoming quarters and years. So I think competition, like we said, for Lululemon is a big thing for Ulta. Similarly, Sephora is the big name that is executing better at the current time than an Ulta Beauty, really eating into those market shares. Now, you have someone like Warren Buffett who certainly thinks Ulta is poised for a turnaround, as Berkshire Hathaway added shares of Ulta Beauty in their Q2 filing. So he picked up nearly 690,000 shares. And anytime I think you have Warren Buffett come in and pick up a stock, that can certainly prove to be bullish for the name considering his track record, and that certainly sent shares higher when that news was disclosed. But I think not a pure reason to invest in shares of Ulta. Just because you have Warren Buffett come in and pick up a stock doesn't necessarily mean you have to as well. This company really is looking like a perfect Warren Buffett name, as the valuation is cheap and this company over the past really has done well. But I think currently the hopes are on this one being a turnaround play, and similar to Lululemon, seems like somewhat of a gamble because you're hoping that this company can figure it out, beat out their competition at a time when they've really shown that they haven't been able to. Now, you had net sales of $2.5 billion. This is for the last quarter, year over year, basically flat, as last year you were also sitting at $2.5 billion in net sales. On top of that, you're losing gross margin, as that slipped down to 38.3%. Last year you were at 39.3%. On top of that, you're not able to control your sales and G&A expense nearly as much. So again, you're losing operating leverage, bringing down those operating margins underneath 13%. Last year, you were closer to 15.5%. So with Lululemon, at least we saw they were able to control those operating and gross margins. With Ulta, we're seeing those margins slip down as well. This company, again, also has a buyback in place. We'll take a look at that in their cash flows. From a balance sheet, it's what you would expect from a retailer, not overly great, as you have right around 400 million in cash and cash equivalents, most of their current assets sitting in that merchandise inventories. Again, not something they can move through rapidly, as they'll have to do high amounts of promotion. And then in terms of liabilities, not a ton, but still right around $500 million in payable, $500 million in accrued liabilities. Most of their liabilities sit in the form of lease liabilities, as they continue to have to pay rent on those additional and existing new Ulta stores. So balance sheet not overly concerning, but nothing that's overly exciting either. From a cash flow perspective, you have nearly $350 million in operating cash flows. This is over the last 2 quarters that you have to show. Again, from a year ago, it is down, as cash flows a year ago were closer to $430 million. What this company is doing is controlling those capex just a little bit, down to $186 million. Last year you were north of $200 million, but consider the fact nearly $200 million in capex leaves you not with a ton in free cash flow, right around $150 million in free cash flow over the last 6 months. And this company is buying back their stock to the tune of $500 million over the last 6 months. So yeah, most of that buyback coming from their cash pile. And like we saw, this company not having a ton of cash, considering those lease liabilities continue to remain there. And so really it's only a matter of time before this company is unable to continue that buyback, reaching into their cash pile. Now, from a technical perspective though, this company is looking extremely good, as you have nearly a 10, call it 12-year uptrend in the making, and shares of Ulta recently having come down and tested that support on the nose at $320 a share. On top of that, you did get a validation, or at least a bounce off of those levels to $385, call it $390 a share. Now, with shares of Ulta, I think a trade here is possible, and you can look to pick up shares at this level, set a very tight stop loss, and I mean extremely tight stop loss, at right around $318 a share, because if you break that level, you're probably headed back down somewhere in the 250s, and that's not a good look. But certainly at that point, if you get a reversal, you can play the top end closer to $400 a share. So you have basically $20 or $30 in downside, in the hopes of making, call it another $50 to $60 in upside if you pick it up at the current level. If you wait for a pullback right at the support level of 330, I think then your downside is far less limited, around $10 in downside, and you're hoping for around $70 in upside. So that's how I'd play Ulta, more from a trade perspective, because you do have this longer term support acting in your favor, at least at the current time. Certainly with this one, a stop loss is highly recommended, because if you break these levels, you're probably heading significantly lower, again underneath $300 almost instantly. Wouldn't really play this from a long perspective at the current time because I think the turnaround still is a ways away. You're still seeing comp store sales decline. And I think until this company shows that they can beat out competition like Sephora and at least hold their own against competition like Amazon, I think from a long perspective, this one is a no touch for me. Last but not least, we're taking a look at Dollar General Corporation, ticker symbol DG, a first here on the channel, and year to date, yeah, it's been a rough sailing with Dollar General as you're down nearly 40% just over the past 5 days. Yeah, this is over the past 1 week. You're down over 33% after they reported their Q2 results. Shares basically fell off a cliff. Now you have an $18 billion valuation on this one. You do get a yield with this, so 2.8% forward yield. With the other two names we looked at, Lululemon and Ulta Beauty, you're not yet getting a dividend, so consider that. You're also getting this at a relatively discounted valuation. Consider the fact that this is in the large discount retail space, so you're not necessarily putting a huge multiple on it even when times are good. Now, right now, clearly over at Dollar General, times are bad. Now, revenue is coming in at $10.2 billion. That was good for just 4% growth year over year. Not only did you get a double miss on the top and bottom line, your same store's sales increased just by 0.5%. Similar story like we saw with Ulta, like we saw with Lululemon. The same store sales really tells the tale, really tells what you need to know about any retailer. You can take a look at Walmart, you can take a look at Costco, you can take a look at Starbucks, for heaven's sake. Like, same store sales really tells you how the underlying business is doing. And anytime same store sales aren't even really keeping up with inflation, that's a telling sign that you're losing pricing power, you're losing your moat, you're losing against competitors in that space. So really, same store sales really paints the whole picture for me from what I need to know. Now, year-to-date cash flows did come in at $1.7 billion. This was for their Q2, so this is 2 quarters of cash flows from operations. $1.7 billion, again, not necessarily bad for an $18 billion company. You're printing, if you annualize this, over $3 billion in operating cash flows. Now, this company does have a fair amount of capex, as we'll get to. Now, in terms of the guidance for the upcoming quarter, this is really what I think sent shares down over 30% on their Q2 print. Is the guidance that they're providing for the upcoming basically full year is that they're lowering those guidance. They're reflecting softer sales trends and related gross margin impacts, which are expected to continue to the end of the fiscal year. So now they're expecting for full fiscal year 2024 net sales growth in the range of 4.7% up to 5.3%. The estimated growth by consensus was for 6%, and Dollar General's previous guide themselves were for 6 up to 6.7%. So they're coming in not just underneath their own previous guide, they're coming in well underneath Wall Street estimates for, again, revenue growth. And that basically tells you that same store sales will go in the negatives as we head into Q3 and Q4. Now, for the full year, they're still expecting same store sales growth of roughly 1% up to 1.6%. Prior guide was for 2% up to 2.7%. Again, diluted EPS also coming in underneath what Wall Street anticipated and pulling back from their previous guide, which was at $6.80 up to $7.55 a share. Now that's expected to be $5.50 all the way up to $6.20. Again, well underneath Wall Street estimates, which were north of $7. So this company, again, pulling those in, and then what they're not really changing is the CapEx spend that they plan to do. So they still continue to plan on doing $1.3 up to $1.4 billion in terms of CapEx, continue to open new stores, remodel over 1,600 existing stores, and then relocate 85 others. So this company, while they're still printing relatively good amounts of operating cash flows, $1.7 billion over the last 6 months, they still anticipate to do nearly 1.4 billion in CapEx. So your free cash flow is looking relatively, I'd say, close to $1.7 billion, in fact, if you annualize it. And so that is a positive, that this company still is free cash flow positive to a pretty good degree. Again, an $18 billion valuation, not overly egregious for this company, but they have no plans to do a share buyback for the remainder of the fiscal year. In fact, I think they have still remaining an authorized share buyback program. And with the shares down, again, nearly 50% over the past 1 year, 38% year to date, this company has no plans to do a share buyback, at least at the current time. So I'm not really sure what management is planning on doing with that cash that they're adding onto their balance sheet with that free cash flow, if you can't buy your own stock at a time where it's basically down over 50%. Yeah, I just don't know what management plans to do with that cash. Now, we look ahead for this company, growth rates on that revenue side expected to be mid-single digits at best, up to 5%. That's anticipated for the upcoming years. And then EPS this year is expected to decline close to 20% and then magically tick back up to nearly 14% for the upcoming fiscal year. Now, I really have questions about whether Dollar General will be able to actually tick back up on their EPS. I guess only time will tell. This company, honestly, at this point, reminds me a lot of Walgreens Boots Alliance. That stock really has struggled as Dollar General's whole moat essentially relied around convenience and discounted prices and really fast shopping. But considering the competition that's out there now for this company, yeah, I think that moat is pretty easily to break apart, especially when you have basically the same alternatives on every street you live on, essentially. And so there might be a reality that Walmart may be destroying the dollar store model. And I know Dollar General and Dollar Tree are necessarily different. Dollar Tree does rely more also on the dollar store model. Dollar General essentially relies on the convenience aspect, that they're really around any essential location and always easy to get to, and again, carry that discounted merchandise. But now consider the fact that you have a Walmart essentially on every corner. You also have Costco, you also have Target, and all these retailers, to stay competitive, have to continue to discount. And so Dollar General's discounted merchandise model really isn't as unique as it maybe once was. And some analysts think that the retailers need to make large investments in labor to restore confidence in the chain. And they believe macro competition and underinvestment within Dollar General are beginning to take a toll. So I think you have, again, similar story like we saw with Ulta. It has competition with Sephora, Lululemon, competition with Alo and Bury. Similar story here, Dollar General's having competition with Walmart, with Target, with Costco, and then even to a large extent to Amazon, because again, Dollar General's whole premise was being convenient. I think with Amazon's same-day delivery, 2-day free shipping, you have a lot of convenience aspects that Amazon can now provide, with again being ultra efficient from a cost perspective from a user. You also have really good return policies. So I think Dollar General's moat just isn't there. I think Costco just is a much better retailer, offering a more unique shopping experience, also getting that recurring revenue through their membership. So the only real reason to pick up shares of Dollar General is if you think the stock itself is deeply discounted, you think its balance sheet looks okay and they'll be able to maybe continue paying a dividend and do a buyback in the future and just generate a consistent amount of cash flows. But I think from a moat perspective, I just don't see it with Dollar General. Now, its balance sheet still looks okay. Look, they have $1.2 billion in cash and equivalents. This is for the quarter ended August 2nd. Year over year looks fairly good. Last year, you were sitting at just $500 million in terms of cash and cash equivalents. You have still nearly $7 billion in merchandise inventory, roughly flat year over year. So that's actually good to see. This company isn't trying to move through a ton of inventory, isn't trying to deeply discount things, but it's also bad to see that they're staying relatively constant on their inventories while they're not able to grow those same store sales. So that's certainly disappointing. And then nearly $6 billion tied into property, plant, and equipment, as you have really large warehouses and stores that Dollar General commands. Now, in terms of liabilities, not a ton. Certainly, you still have a fair amount in lease liabilities. That is the current term of the rent on their Dollar General stores, roughly around $1.4 billion, relatively flat again year over year. You have long-term lease liabilities of nearly $9.7 billion. So this company, I think the lease liabilities, the rent that they pay, certainly the biggest factor I think that this company needs to consider. Now, from a cash flow perspective, you have that $1.65 billion in operating cash flows. This is for the last 26 weeks. So over the last 2 quarters, again, $1.7 billion in operating cash flows, not actually that bad. Over double of what they were earning in operating cash flows same time last year. So that's good to see. This company is still generating a fair amount of operating cash flows. And then you see nearly $700 million in terms of property, plant, and equipment purchase. So that's their CapEx spend. Year over year, you actually see that's declining. So relatively okay to see that CapEx actually being held in control. And so you have nearly $1 billion of free cash flow to play around with. And yeah, this company just doesn't do a lot. You see a lot of these line items are empty. They pay out a dividend of nearly $250 million, nearly $300 million that they can easily continue to pay out, in my opinion. I think you really have no risk of a dividend cut anytime soon, considering that dividend isn't exorbitant compared to their operating cash flows. But yeah, this company just isn't doing a buyback at the current time, and I'm not really sure why. They added close to $600 million onto their cash pile. And yeah, like we see from their technicals, the stock has been in a downtrend for quite some time now, dating back to November of 2022. Yet this company just doesn't do a buyback. So that has me a bit baffled. Also has me questioning management and really what they're seeing out into the future, why they're choosing to hold off on that buyback at a time, again, when your stock is really falling off a cliff. Now, over the past, call it decade, from 2010 up to 2022, this company was in probably one of the most well-defined uptrends that you could have found out there. Since then, though, since the highs of 2022, yeah, you've posted a significant decline of nearly 68%. That is just enormous to see a decline of 68% in a very quick time. Less than 2 years, you're down over 68%. This is on a weekly time frame, so you've posted these enormous red candles on a weekly time frame. We take it to a daily time frame. Yeah, those red candles just replaced by large gaps in the price action. So on your way up, if you expect this company to have a rebound, your hopes are as the price action sort of levels out and settles out, this company essentially fills those gaps it made on the way up using probably a bunch of green candles as it continues to head up. So certainly from a technical perspective, you could look to play the reversal. At this point, these are very large falling knives. And so I would be very careful stepping in and trying to pick it up at the bottom. You're essentially trying to time the bottom, whether you want to call it or not. You're trying to call the bottom in shares of Dollar General if you step in and pick it up at this time. And really no one knows when the bottom for a stock like this will be. Certainly from a technical perspective, you can find some support at the current $80 to $80 level. And so if you want to play a trade at this point, certainly you could look to do that. I would, if you do that, set a tight stop loss underneath, basically at $75. Maybe if you want to go a little bit more risky, you could set one closer to $70 where you found, again, long-term support dating back all the way to 2016. But again, from a technical perspective, these are falling knives and it's very difficult to catch them at this point. What I would rather do is wait for this one to settle out, at the very least, trade sideways for a little bit. I really see no reason for this one to have a V-shaped recovery because the fundamentals aren't really there yet. Management hasn't told you that they're going to do a buyback, so you won't have Dollar General come in themselves, pick up a large amount of their shares. So I think this company at the very best continues to chop sideways within this channel. Really any pop to the upside should probably be reasons to sell if you're in this one, because look, you have a lot of investors stuck at this one at these elevated prices, and as shares continue to move up, you'll have those ones hitting the exit button, hoping to just cut some of their losses. So keep that in mind. I think this one, until it breaks out of this downtrend pretty significantly and continues to show that, okay, it now is in a pattern of higher highs and higher lows, until it really puts a couple of really big green candles telling you that, yeah, there's significant price action pushing us out of this steep downtrend. I think this one still is probably a no touch, again, from a technical perspective as well. And then fundamentally, yeah, I just don't see it with Dollar General. I don't see a moat around this business. I think Amazon can really eat up this business at any point it likes. They're willing to lose money on small ticket items. They're also willing to lose money on returns. And same with Walmart. I think they probably have a better value proposition than Dollar General. And I just see this one going the same ways as a Walgreens has. And you can pull up the shares of Walgreens. Those have not looked pretty. So that was my take on shares of Dollar General. One I would stay away from a fundamental perspective until you see same stores sales at least tick up more than I'd say inflation is. And then from a technical perspective, I'd also be very careful with this one. It seems tempting considering the huge decline in shares over the past week, year to date, 1 year, but consider the fact that those large gaps, as they get filled, we'll see lots of selling pressure on the way up. So just be very careful if you do enter this one from a technical perspective. Now, if you're like me and you don't really find any one of these three names all that interesting, both from a fundamental long perspective, also from a trading perspective, seems quite risky because you're making gambles for the short term, you're making turnaround play bets. I want to introduce two ETFs that could be a great way to play this retail space without taking the outside risk of investing in a stock that then drops nearly 35% in 1 week. The first way to do that is through the Van Eck Retail ETF, ticker symbol RTH. Your top 10 holdings include Amazon.com, Costco, Walmart, Home Depot, Lowe's, TJX, we go down the line, CVS, Target as well. Now, the one thing with this ETF is that Amazon makes up nearly 20% of it, so you are quite top heavy, with Amazon making up nearly 1/5 of the whole portfolio, or 1/5 of the whole ETF. So in case you have shares of Amazon which you probably do through other ETFs or outright shares of Amazon, you might not want to jump into this one just because of the huge risk you're taking by investing pretty much most of your money in Amazon. The other way you can play this is through the Consumer Staples ETF, ticker symbol XLP. So I think this one is much more balanced. Also has some diversification into just general consumer staple companies like Procter & Gamble, Coca-Cola, Pepsi, Colgate, things like that. And you also still get retailers like Walmart, Costco, again, Target, making up a good portion of this ETF. So I think this is actually the way that I would play the consumer staples space, even the retail space altogether. I'm not really that interested in picking up shares of Ulta or Lulu or even Dollar General, because at the end of the day, you're hoping for a turnaround, which again could materialize and could see those shares appreciate, but you have to have the ultra confidence in those management teams. You have to really understand that the retail space is ultra competitive, like we're seeing with all these companies, and that margins are just ready to be taken over by competitors. So you're always going to be struggling with pricing power unless you're very early in your category, like Lululemon probably once was back in the early 2010s. So that was my take on shares of Lululemon, Ulta Beauty, and Dollar General. Let me know your thoughts on this one in the comment section below. Also, those two ETFs are probably the way that I would play this space. Not really interested in taking a crack at any of these at the current time. I think either the valuation needs to go lower or simply these companies' same-store sales just need to be better. Hope you guys enjoyed this retail roundup. Let me know your thoughts on each of these companies in the comment section below. If you made it through to the end of this video, be sure to hit that like and subscribe button below. It would be much appreciated. As always, thanks so much for listening, and I'll catch you guys in the next video.